Okay. Now, before we start, guys, I just want to clarify something. By mistake, I think at the end of the last lecture, I misread the question. This is why you should not go quickly over any question. Read it carefully. I did not, and if it were not for one of your colleagues, I would not have paid attention to the fact that I misread here. It says accounts written. I thought that it was recovery of accounts written. Okay? So originally what I did, I had debited and credited the amount that was written off. Instead, you do not do that. You don't need to debit and credit that amount. They were written off, so you just credit accounts receivable. Okay? If you remember, the journal entry to write off an account is to do what? Debit? Debit what account? Allowance and credit? Accounts receivable. So because they were written off, we simply credit accounts receivable. I just wanted to remind you of this. Okay? If we actually had a recovery of written off accounts, this is what we would have done. We would have debited and credited, or not included it at all. Okay? Any questions? So last time we talked about land, right? We started talking about property, plant, and equipment. If you remember that, we said that it's called also, sometimes it's called like plant assets, it's called fixed assets, PP&E, and we said that it is recorded as cost. Cost might include actually brokerage fees, attorney's fees, any sales taxes. So those are the things that are not recurring expenses, like for example insurance. So if the company was buying an equipment, and the company paid insurance for the transit, that's before it is actually ready for its intended use, then this insurance, transit insurance, would be included in the cost. However, the actual insurance policy that the company might buy later on, for example, a 3-year insurance policy, that's not included in the cost. That's a recurring insurance expense. Okay? So the first item that we discussed last time was land. And the second part of it, so we talked about land, and one thing we mentioned specifically about land was that land does not depreciate, right? Because land is expected to have an indefinite life. So the useful life of a land, if you have a land, the useful life is indefinite. This is why you do not depreciate the cost. Land improvements are whatever you add to the land, such as pavements, for example, fences, lighting. Those they would require, they have a limited lifetime. So for example, if you buy a light bulb, it would say that this light bulb would work for 10,000 hours, right? They have a useful life. So land improvements, on the other hand, they depreciate. Remember what we talked about when we talked about depreciation? Depreciation, what it means, it's an allocation of the cost. Basically, this is dividing up the cost of the asset over the useful life. The useful life is how long you expect it to serve you. Okay? So, land improvements, if the company, for example, purchases some fences and install them on a certain land, that cost would be included or would be debited to land improvements, okay? Now, buildings, a building can be one of two, basically it's one of two ways. The company might either construct that building, they start with a building from scratch, they build it, or it might be a building that they purchased and then they modify it or they adapt it to their own use. Remember that plant assets are supposed to be used for business operations. They are not used as investments. They are not used, the main intention or the main objective of buying a building, in this case, it would be to use it for your own operations, such as offices. Okay? It's not to sell to like a realtor. That's a different thing. So in this case, for example, look at this building here. When Rutgers built 100 Rock, this building, they had to pay the architect. They had to pay certain taxes, licenses, etc. They had to pay the contractors. Okay? The material. All these things until the building was ready to be used for its intended use, which is in this case, it's a business school. The intended use was to have chairs. So at this point, until that point, the chairs that were included in the construction of this room, that will be included in the cost of the building. The cost of the building, in this case, is not simply the walls and the ceilings. It's whatever goes into that building until it is ready for its intended use. So if the company, if Rutgers, instead of actually building a whole new building, if they went and they purchased an existing building and they had to modify it, the modifications, for example, it was just one warehouse, and they had to partition it and split it up into classrooms and offices. So those partitions, the cost of partitioning that building is included in the cost, right? Painting, remodeling, this will be included in the cost. So this is why we have the purchase cost. This is if the company is buying the building. Included in that one would be any brokerage fees, attorney's fees, taxes. If there were, for example, need to replace maybe the carpets or repaint the walls, something like that. All this is included in the cost. When it is a construction, you add basically, in addition to the cost of the actual construction, you add to it building permits, the cost of basically like excavation costs because you need to place the bases, etc. Now, the foundations and all these will be included in the cost. Now, with construction costs, sometimes the company might have to finance, basically take a loan for them to be able to build that building. Okay? In this case, if the cost is big, if this interest is big enough, it is included in the cost. However, only during the period of construction. As soon as. So in this case, because in certain cases, to take a loan in order to build this building would be as important as actually buying the material, because you cannot build the building without material. You also cannot build it without the proper funds, right? So if you take a loan, the interest in this case might be included in the construction cost. This is only for the period of construction. Once the building construction is complete, the interest in this case becomes an interest expense. It's not included in the cost anymore. It's only during the construction period. Okay? Equipment, we've discussed that before. Again, if you buy a truck, if the company purchases a truck, it's not just a purchase price. It's a purchase price. You add to that any sales taxes. If the company is paying for the shipping, you add to that freight expense. If there were any insurance during shipping, that's transit, for example, then it is included in the cost. If the company needed to paint the truck, so for example, if Rutgers purchases a van or truck, they will be painting the R, right? The scarlet R. So this red R, the cost of painting it is added to the historical cost of the equipment. Now, the licenses from the DMV, the insurance, the policy insurance that is paid regularly, even if the company purchases that in advance, that will not be included in the cost. Those are recurring expenses. Prepaid insurance will be an asset. If you remember, as you remember, this is what kind of what kind of accounts? Prepaid insurance. And remember, we learned about that when we studied deferrals and accruals, right? This is deferrals, right? This is when we learn how to make adjusting entries to recognize the expense of insurance after it passes. But when the company purchased that, it's not included in the cost because this expense is a recurring one and it will be an operating expense. So for example, Leonard Company purchases a delivery truck at a cash price of $22,000. Related expenditures are sales taxes, painting and lettering, motor vehicle license, a 3-year accident insurance policy. How do you calculate? Which one do you include? Sorry, Matt.
You include the sales tax.
Well, first you include the cash price.
Yeah.
This is the amount that was paid. Okay.
Yeah.
And then sales tax.
Sales tax. The lettering.
Okay.
And you do not include the motor vehicle license, it's a recurring expense.
Okay.
And you do not include the insurance policy because it's an asset.
That's correct. So basically what you need to include the cash price. This is the price that you paid for the truck. Okay? You also include the lettering. This is preparing it to have the motto, the logo of your company. You also have to pay the sales taxes, but you do not include the recurring motor vehicle license fees as well as the accident policy. The insurance policy, this is a 3-year, this is a recurring expense. It will be prepaid insurance, and then later on, with time, we start expensing it into basically by recording interest expense. Okay? So this is why the cost of the truck will be $23,820. Now this is the same material, information. How do you prepare the journal entry? Again, let's think about it, about what happens here. Laura. You debit equipment how much?
For the cash price cost and then the cost letter.
So basically the cost. Okay? So you debit equipment, the cost, which is $23,820. And next, what do you do? How much we know that the company paid in cash, right? Cash price. So how much the company paid in cash? Sorry? 22,000. What about the remaining payments? They paid them also in cash. That's actually correct. The company will pay this amount. This is how much the company paid. Think about it as a simple. Think about it as a simple economic event. What happened? The company paid cash this amount. So you know for sure that this is the amount of cash that the company will be paying. Okay? So this is the amount that the company will actually pay. The company will pay in cash the motor vehicle license. They will pay in cash the prepaid insurance. So this is the amount of cash that was paid. They paid for 3 things. They paid for the truck and the cost of the truck, the cost of the equipment. So we debit equipment, the cost of the truck. Not the purchase price. Do not mix purchase price with cost. Purchase price is only a part of the cost. So we debit equipment, cost, and then we will debit also the other expenses. So you have the license expense and the prepaid insurance, which is in this case, it's an asset, right? So this is how you write the journal entry. Any questions about this? Okay. Okay. So, that was not very, very disappointing. Just slightly. I wanted in the 90s to be honest. However, so how do you calculate the cost of the truck? Again, partner. The cash price plus sales tax plus the lettering. We do not include accident insurance nor motor license vehicle. Okay? So you guys now know how to calculate the cost of equipment. That will be important. Because once you calculate the cost of equipment, we get to depreciation. Now, what do we mean by that? Remember, depreciation is not a valuation method. We're not saying that this is a fair market value. All we're doing is we are splitting up the cost of that asset over the useful life. We are allocating the cost of that asset over the useful life. What do we mean by useful life? This is how long the company expects to use that asset. Okay? This one, it applies again to all plant assets except land. Remember, you never depreciate land. Okay? Now, what's the concept of depreciation? Why do we depreciate an equipment? Again, we discussed that before. The idea here is that the equipment will have a limited life. It's not going to serve you for example, a truck. It's not going to serve you for good, for life. It's going to serve you for, let's say, 5 years or 10 years. So you have to split the cost over those 10 years. First of all, it's not fair to recognize all the costs in the first year because you will still be using it later on. We need to match expenses with revenues. So you have to match the expense, which is the usage of that, the expense that is incurred from the usage of that truck, okay, over the useful life. By the useful life, we mean this is the time when that equipment or that asset is actually generating revenues. Okay? And usually, with the exception of land, we expect a certain such an asset, like for example a truck, it will become useless after a certain period of time. The concept of useful life comes from the fact that after a certain period of time, it will either become obsolete, like an old computer, even if it were functioning correctly and it was still in an excellent shape, you cannot use it to run the current software, right? So even if it were good, it becomes obsolete. This is why you have to, it has a certain number of years that is useful. In other cases, it has basically the productivity of that asset will decline because of simple wear and tear. Like a car. The more you drive the car, the higher the probability and the likelihood that this car will have a problem. So a new car or a car that has run like 10,000 miles would be more productive than a car that was used for like 300,000 miles, right? The one with 300,000 miles, you expect it to fall apart much more often. This is basically it. So this is why we say that they have a useful life. The building, after a certain period of time, no matter how much you maintain it, the building more or less will be demolished and then they will rebuild it. So there are different factors that affect the calculation of depreciation. Okay? If you remember, so far we learned how to write the journal entry. How do you write the journal entry for depreciation? Yes, go ahead, don't be afraid.
The depreciation cost.
Yeah, so depreciation expense, you debit depreciation expense and you credit accumulated depreciation, right? Now, in the previous, you don't have to hit him, he did well.
Reassurance.
That's reassurance. I don't want to see when you're upset with him. In this case, you have, so far we have been told the estimated amount of depreciation, etc. So the problems in the first part of the course, if you remember, they will tell you straightforward depreciation expense was 2,300, something like that, right? We were given the amount of depreciation. Now we will learn how to calculate it. Now most companies, in order to calculate the depreciation expense, they have to take three variables into consideration. The first thing is the cost of the asset. Makes sense, right? This is the cost that you are allocating. This is the cost that you are splitting. So there's the cost of the asset. There's the useful life. This is how long you expect it to be in use. It could be either in time. For example, it would be useful for 5 years. It could be in units of activity. This is, for example, like we said, the light bulb. They're not going to tell you that the light bulb will work for 5 years. They will tell you it will work for example, 10,000 hours. Because if you keep it off, it might go for 100 years. Okay? So it depends on the usage. Sometimes, if you are having a machine, equipment, or something like that, they will tell you, okay, so this truck is expected to be used for 200,000 miles, after which the value will decline, it will be useless. So the useful life, we have the cost, useful life, and the salvage value, which is also sometimes called residual value. What do we mean by salvage value? This is whatever, after the company has finished using the truck, they still expect, even after 5 years or 10 years, they still expect to receive some money in return of selling that truck, even if they were to sell it as scrap. Okay? The metal itself will have some value. So for example, if they purchase a truck for $20,000, they expect it to be used for, 6 years. They might also expect after 6 years to still be able to sell it for 1 or 2 thousand. That will be the salvage value. This is the amount of money that the company expects. It does not mean that this is actually how much they will receive. This is what they estimate they will receive after the useful life. Okay? So remember, we need those 3 items to calculate depreciation expense, the amount of depreciation. Most companies, they use one of 3 methods. They either use the straight line method. As you can see, over 80% of companies, they simply use straight line method. Straight line method is the simplest one of them. How do you do that? The truck is supposed to be used for 5 years. Divide that cost over 5 years. Now you divide not the cost, but the depreciable cost. We'll see in a second. What do we mean by depreciable cost? Okay? So you divide the depreciable cost equally over the useful life. If it were to be used for 10 years, you divide it over the 10 years. You allocate it equally over the 10 years. The units of activity depends simply on the number of units. So for example, if it is a machine, you expect it to produce 10,000 units. After 10,000 units, so you allocate the cost over 10,000 units per unit. And every year, it depends how many units you use it for, it produced. The truck, it would be, for example, it could be the number of miles. Okay? The lamp, like we said, if you want to depreciate it, it will be by working hours, not just the hours in life. It's basically how many hours you actually turn it on. Of course, you're not going to depreciate a lamp because it's not worth it. But again, there's the materiality concept here. The declining balance method is the third method, which is, the idea here is that newer products are more productive than older ones. So a machine that you just purchased will be more productive in year 1 than it is in year 2, right? And in year 2, it will be more productive than in year 3. This is why they call it the declining balance. Okay, so you believe that the productivity will decline with time. As a result, the value of it will lose value faster. So this is why sometimes they also call it accelerated method. So it will lose value in the first year much faster than it would lose it in the second year. Under that, the company has the right to use whichever method they want, depending on their own judgment. They have to use their own judgment. Accounting has a lot of judgment. They have some rules and guidelines. This is GAAP. And then the company has to use their judgment in picking the one that suits their company best. It's like with when we learned how to calculate inventory. Whether the company is going to use LIFO or FIFO, that depends on the management decision. Same thing here with depreciation. The company will decide what suits them best. So let's take this example here. Barb's Florist purchased a small delivery truck on January 1st, 2015. The cost was $13,000. Expected salvage value is $1,000. Estimated useful life is 5 years or 100,000 miles. Okay? So the truck would be useful for 100,000 miles, or it will be used for 5 years. By the way, if you guys drive, you will see that the oil life, usually they would give you either, for example, you have to change it within 3 months, or I'm just giving an example. You need to change it either in 3 months, or you would have to change it after, say, 2,000 miles. So they would give it to you in units of activity, that's how many miles you drive using that oil, or using the lifetime, basically using a time base, which is 3 months or something like that. Okay? Now we will learn how to calculate that using the 3 methods. Okay? So for the straight line method, we start with a straight line method. Here the assumption is that every year the depreciation expense will be the same. We simply divide the depreciable cost by the number of years, by the useful life. Okay? Now what's the depreciable cost? The depreciable cost is the amount that you need to depreciate. This is the cost minus the salvage value. It's the cost minus salvage value. Why? You're not going to depreciate what you are going to receive later on when you sell it. You're going to depreciate whatever is allocated as cost. In this case, it will be 13,000 minus 1,000. This is the amount that you will be splitting over the useful life. We said it was useful for 5 years. You simply divide the depreciable cost by 5 years. That will give you the annual expense. That's the annual expense every year. So if you were to calculate the depreciation expense for 6 months, how much would it be? So this is for 12 months. For 12 months, it will be 2,400. If it were for 6 months, how much would it be? 1,200. Basically, this is the annual depreciation expense. So the company, when they are actually depreciating, they prepare this kind of table to calculate the book value. You remember what the book value is? Who can tell me what the book value is? Laura. The cost minus the accumulated depreciation. This is whatever, according to the company's books, this is the value of the remaining value of that equipment. Remember, this is not the market value. This is what the company believes it's worth. It does not mean that this has the same value as the value on the market. This is not a valuation method. This is an allocation method. So in this case, the depreciable cost is always the same. What's the depreciable cost? 13,000 minus 1,000. In this case, it is 12,000. Now, companies, they can calculate it in one of two ways. They can either directly calculate the annual depreciation expense, and we learned that this would be 2,000. This is 12,000 divided by 5 years. Or sometimes companies, what they do is they use the rate of depreciation, annual rate of depreciation. How do you calculate the annual rate of depreciation? This is 100% divided by the useful life. In this case, it's how much? 100% divided by 5. Well, that would mean this is 20%. Basically what you're saying is, every year I will be depreciating 20% of the depreciable cost of that asset. So in this case, it will be 1,000 multiplied by 20%. This will be 2,400. So you're actually saying the same thing in a different way. You're simply saying, instead of doing 12,000 divided by 5, you're saying, okay, so 12,000 multiplied by 100% over 5. It's the same thing. Okay? So for the first year, for 2015, what's the accumulated depreciation? 2,400. What's the book value? Sorry? 13,000 minus 2,400. The book value is equal to the cost, not to the depreciable cost. Book value is the cost minus accumulated depreciation. This is the value. It still has the $1,000 that you will receive at the end as the residual value or salvage value. This is still part of the value. Do you understand that? This is still part of the value. Now, how much would it be in 2016? What would be the depreciable cost now? The same. So it's basically the same thing every year. Except for depreciation expense, of course, and the book value, because those will be changing every year. Any questions? And by the way, using Excel, if you guys want to use Excel with this one, there's actually a formula that I think it's called SLN. You just put those values, it will create a table for you. If we have time, I will show you later on how to do that. I mean, you don't have to do it for the course. I'm just telling you that if you go work in a company and you need to calculate depreciation, you need to create such a table, you can do it actually in Excel. It will be very, very, very quick, very fast. So now, for depreciation, accumulated depreciation will be, every year it will add 2,400. So for the third year, it will be actually 7,200. Now, the book value is always equal to cost, the original cost, 13,000 minus accumulated depreciation. Okay, any questions? And this is why at the end of the fifth year, you will see that the book value is now 1,000. This is the salvage value. The book value is not going to be 0. This is the value that you expect to receive it. So basically, we did not depreciate it at the beginning. However, it was still there as salvage value at the end once we were done. Any questions? Yes, go ahead.
Would the company figure out the way to determine the salvage value and then based on how many years the useful life would be?
They expect, for example, let's say that they have a truck which will be used for 5 years. They have a Ford truck. They look in the market. How much is a Ford truck that has a life of 5 years? How much is it sold for? If they find that they are selling it for $1,000, they know that, okay, so the salvage value is approximately $1,000. Maybe after 5 years, it will be actually $2,000. In certain cases, maybe they had several accidents, and as a result, the value is $200. Then it will be the actual salvage value. But the salvage value that we have here is the expected salvage value. This is how much the company expects from their experience. Maybe also from their own experience. Like UPS, for example, they have trucks that they depreciate all the time. So with time, they know that after 5 years, this is how much they usually sell it for. The journal entry will be always, you debit depreciation expense, credit accumulated depreciation. The amount will depend on how long it was. So in this example, annually, it will be 2,400. Let's say that instead of buying that truck at the beginning of the year, you actually bought it on April 1st. So instead of buying the truck on January 1st, you will still be using it for 5 years. So it will end. The usage of that one, or the useful life of the truck, will expire, or will end at the end of March 2020. So this is basically at the end of March. It's exactly 5 years. However, instead of starting 1 year, basically at the beginning of the year, you started on the 4th month. So for the first year, you cannot depreciate 1 whole year. You are preparing your financial statements December 31st. So on December 31st, you will be writing depreciation expense. However, you have to calculate how many months depreciated. How do you do that? The same amount, the same thing. You multiply depreciable cost by, you divide it by, or you multiply it by the depreciation rate, and then you multiply it by the number of months in year, basically the number in years, or basically how many months. It's 9 months. In this case, it's 9 months. You multiply it, this is partial year. The same amount, 2,400. You multiply it by 9 over 12. The last year, because it will only be January, February, and March, you expect it to be sold, or basically you get rid of it. End of March, it will be 3 over 12. So for the first year, the book value, the accumulated depreciation will not be 2,400, instead it will be 1,800. The book value is, in this case, this is the accumulated depreciation. The book value in this case will be 13,000 minus 1,800. Not 18,000, 1,800. Okay? So when you present it on the balance sheet, you will say that, okay, I have equipment, the cost was 13,000, less accumulated depreciation 1,800. Okay? The second year will be a full year, will be 12 over 12. This is actually, this table here is the same thing as this one. If you wanted to do it from the beginning, you can simply here multiply it by, for example, multiply by 12 over 12. Multiply by 12 over 12. That's the same thing. In this case, it will be simply that the first one is multiplied by 9 over 12 because only 9 months, you had the truck for only 9 months the first year. So you have to depreciate for 9 months and not for 12 months. Do you guys have any question on this one? Am I going too fast or is it good? Okay. Units of activity is different. So units of activity, like I said, you simply divide the depreciable cost by the number of units. In this case, you're not dividing it by the number of years, you're dividing that by the number of units. If the truck is supposed to be used for 100,000 miles, you simply divide $12,000 by 100,000, that would be 12 cents per mile. So if in this first year you drove the car for 10,000 miles, multiply that by 12 cents. If you drove the truck for 40,000 miles, the second year, multiply 40,000 miles by 12 cents. It's going to be the same thing every time. And then we use the same table. The company would do the same table. So in 2015, the depreciable cost was how much? 12,000. We calculated here the depreciable cost per unit. Okay? Depreciable cost per unit was 12 cents. You multiply 12 cents by the number of units of miles driven. In this case, it was, let's say, 15,000. That's easily traceable. The company can easily track how many miles they drove each truck every year. So it's 15,000 multiplied by 12 cents. That's the annual depreciation expense, which is also the same value as accumulated depreciation. The book value in this case will be, once again, 13,000 minus, right? In this case, what you need to do first in those kind of problems, what you need to do first is to calculate depreciable cost per unit. Simply divide the depreciable cost by, you divide it by the number of units, right? So in this case, you get the book value now is 11,200. Now it's important to calculate the book value. We'll learn later on why. This is when you sell the truck before it is actually before the end of the useful life. Okay? The second year, let's say that the company used it for 30,000. Multiply 30,000 miles by 12 cents per mile. This is the new depreciation expense. What's the accumulated depreciation now? You add this amount to this amount, right? You add the first accumulated depreciation plus 3,600. Now this is 5,400. This is the new accumulated depreciation. So the book value will be equal to 13,000 minus 5,400. The third year, so this one, it depends basically every time. It will simply depend on the number of miles the company used that truck for. As you can see at the end, you are still left with the salvage value. Any questions? Okay. Journal entry is always the same. Debit depreciation expense, credit accumulated depreciation. Never, ever make a mistake with that. We get to the declining balance method. Declining balance method. This is slightly different. First of all, you do not start with the depreciable cost. You start with a book value. So here you start with the book value. You apply the rate, the depreciation rate to the book value. Remember, how do we calculate the rate, the depreciation rate? 100% divided by the useful life, right? So in this case, it's 20%. That would be for the straight line method. Now, one method that is very popular in the declining balance method is what we call the double declining balance method. Double declining, it simply means that this is the double of the straight line method rate. So the straight line method, you divide it by 5 years, right? So it was 20%. If it were 10 years, what would be the straight line method depreciation rate? 10%. So the double declining balance method in that case would be twice that amount. Double declining balance, you always calculate first the depreciation rate for the straight line method multiplied by 2. That's why it's double the declining balance method. So in our example, it was 5 years. So the double declining balance method, the rate of depreciation would be 2 times 20%. That's 40%. You multiply 40% by the book value. This will give you the annual depreciation expense. Okay, so let's see how this is done. What's the beginning book value? As soon as the company purchased the truck, what's the book value of the truck? 13,000. It's not the depreciable cost. This is the value of the truck. It's 13,000 at the beginning. Multiply 13,000 by 40%. This will give you the depreciation expense for the first year. It's 5,200. Accumulated depreciation is 5,200. Now you calculate the new book value. The new book value is 13,000 minus 5,200. Okay? So it's 7,800. Now this is your new book value. This is the new book value. Now, the book value again, yes.
Isn't this kind of misleading as opposed to the straight line one? Because didn't you say in the original example you gave us that like if you did it all in the first, like right when you bought it, that your like net income for like the next quarter or whatever would be a lot higher than the previous one?
But in this case, you're not doing that only for the first year. You're doing that. You are splitting the cost for over 5 years.
Yeah, but the first one's still gonna be a lot
The idea was that a computer, the productivity of the computer in the first year is much, much higher than the productivity of the computer in the second year. Why? The speed, the memory, the storage is much more efficient in the first year than the second one. A machine that produces, I don't know, chairs, the manufactured chairs, will be much more productive in the first year than the second year. So, because the productivity, the revenue generation ability of that machine, it will go down with time, right? Which is to mean the revenues will go down. As a result, the expense will also go down. This is here that's a good question. Why don't we just use the straight line method? Because in certain cases, the idea is that they will lose value faster. As you can see here, the book value lost 5,200 in the first year. So let's do the second year. The second year, again, you see here, the expense now is 3,000 instead of 5,000. It's less. Why? The assumption here is that the revenue generation decrease. As a result, the expense should also decrease. In the same way, expenses, they follow revenue. Okay? So now, again, accumulating depreciation is 8,320. As you can see now, in the second year, by the end of the second year, the book value of the truck is around 4,700. Let's say that it's 4,700. That's out of 13,000. Because you believe the second year the truck will have more trouble, they will need more maintenance, the tires will be changed more often, the brakes will have to be changed, etc. So the productivity, the amount of days that it can actually work will decrease. As a result, the company would consider that it would make more sense to depreciate more in the first year when it's generating more revenues than to depreciate in the second year when the productivity has decreased. And even in the third year, it will be even lower and lower. Okay? Now, one thing that you have to understand, in the last year, remember that what you need to do is you still need to get to the salvage value of 1,000. Okay? So for the last year, for the fifth year, the company plugs in 1,000 at the end, and then they recalculate this one. Because if you were to calculate 1,685 multiplied by 40, that would be 674. But that would be short of $11, right? That would be short from the salvage value. So to get to 1,000, the last year you actually do it backwards and you put 1,000 at the end here, and you calculate the expense here. You guys understand this one? And as you can see from the graph, the majority of companies actually they simply use the straight line method because it's easier for them, makes more sense, just split the cost over 5 years. Calculations are easier and stuff like that. Any questions about this? Double declining balance, you have to remember one thing. It's not the depreciable cost, it's the book value. You multiply the book value by depreciation rate. For the double declining balance, depreciation rate is twice or the double of the depreciation rate for the straight line method. So you calculate the straight line method, depreciation rate multiplied by 2. This new depreciation rate multiplied by the book value. And every year just multiplied by the book value. Any questions? In the exam, for example, you might be asked what was the depreciation expense in year 3? Or what was the book value at the end of the second year? You have to know this. You have to be able to do that and do it basically fast. So it's not that you won't know how to do it. it will simply take you time to do it. Be careful. Learn how to do it fast. And by the way, this is again something that Excel can do very quickly. Now, if you have partial year, once again, you multiply it, because we were calculating the annual depreciation rate. So if you have a partial year, multiply the partial year, here like for example 9/12. The last part will always be you plug in the number that would lead to the full accumulated depreciation of 12,000. Here if you have the book value, it will be here 1,000. So basically what you need to do is you need to get to a maximum where it is 1,000. As you can see, using the three methods, any of the three methods, you will get eventually to the same total cost and total depreciation expense. You get the same salvage value. The only thing that's different is how much is allocated for every year, for every period. This is it. But if you look at it as a total, it is going to be the same thing. Any questions? Okay. So this one, it shows you the difference over the year. Well, the red line here this is the straight line method. It depends on the number of years. It's straight, it's going to be the same thing every year. The same depreciation expense every year. Given that it is a full year. Okay? The same annual depreciation rate. The declining balance method, in this case, is it will start with a high depreciation the first year, and then depreciation expense will decrease with time. As you can see at the end, like in this example, for the last year, depreciation was 685 compared to the straight line method, which was always 2,400. So at a certain point, it changes, and basically it becomes less depreciated. Okay? The depreciation expense decreases. The units of activity, it depends strictly on the amount of, based on the units that were used. Any questions? But at the end, you have the same accumulated depreciation, whether you use one method or the other. It's the same thing. It's simply what changes is how much is allocated for every year. Let's do this one. Remember, when you use the double declining, basically the declining balance method, what you do is you calculate, basically you multiply the depreciation rate by the book value for the units of activity, and the straight line method, use the depreciable, you start from the depreciable cost. Okay. So we did have the majority who got it right. Basically, they're telling you how much the company purchased the truck for, etc. The different things. What you need to calculate is the depreciable cost. And then you divide that by the useful life. It has a 5-year useful life. What you need to calculate is the depreciable cost. First of all, you calculate the cost, right? What's the cost of the truck? Sorry? So how do you calculate it? It's 60,000 plus 2,800 plus 8,000. This is to build a foundation to make it running. Remember, until it is ready for its intended use. So that would be how much? 70,800. Now, the company expects to have a $12,000 salvage value. So the depreciable cost, so this is the cost. Depreciable cost will be equal to 70,800 minus salvage value. This is equal to, someone did the math, right? Sorry? 58,800, right? This is what you divide by 5 years. That will give you 11,760. That's the annual depreciation expense. Okay. Now they are using double declining balance method. Remember, this one use the book value and the depreciation rate is twice the straight line method. And just to let you know, I will make a video of the whole chapter available today. Even if we do not finish it today, I will just make it available for you guys if you want to start preparing. I will also post the sample exam. It's not a full exam, it's just like a few questions that will give you an idea of what the exam is. Hopefully this weekend. Give you more time to prepare for the exam. When you have a question like that, especially in the exam, do not try to jump to the answer directly. Do the whole table. Trust me, it will take you more time, but you will guarantee the answer. That's not complicated, it's very simple. All you need to do is do the math, basically. Okay, like I said, this question is harder, so I totally understand that. The way to do that is to calculate depreciation expense for every year. We are using the double declining balance method. Salvage value is 2,000. It has a 5-year useful life. The cost was 40,000. Okay? The amount to be depreciation expense recognized in the year 2012 will be, you start from the beginning, 2010. Depreciation expense is equal to book value of 2010, right? So book value multiplied by depreciation rate, right? What's the depreciation rate? It says double declining balance. It has 5 years, so it's 100%. Divided by 5 multiplied by 2. So that's 40%. So for the year 2010, actually that's the formula for all of them. For 2010, depreciation expense is equal to, book value was 40,000. You do not, this is the book value. It's not the depreciable cost. You do not subtract the salvage value. So it's 40,000 multiplied by 0.4. That would be how much? Sorry? 16,000? For 2011, depreciation expense will be equal to 40 minus 16 is how much? 24,000 multiplied by 0.4. This is equal to 9,600. Now, for the third year, 2012, depreciation expense is equal to 9,600 multiplied by 0.4. That's equal to 5,760. Sorry? Oh, sorry. 24 minus this amount. How much is it? Sorry? 14,400. Right? Any questions? Okay. This is what you need. Trust me, this is what you need to do. You have to do it regularly. You have to do it one step at a time. Do it for every year. It doesn't take you that long once you get used to it. If you're trying to learn how to do it in the exam, you will not do well. The third one is for the, which one? They are using the straight line method. So the straight line method, again, is one of the simplest methods, right? Oh, ignore that. We won't do this question. Well, I still haven't explained how to do it. Because here it's changing. Sorry, my bad. I combined the questions. Ignore that one. Don't worry. Don't worry. Okay, now depreciation and income taxes. I shuffled the questions last night and I did not pay attention to this. And, so according to according to GAAP, what the companies use for financial reports, they use one of those three methods. They have to disclose which method they use. For the IRS, for tax purposes, companies, they will either use straight line method or what they call the MACRS, which is Modified Accelerated Cost Recovery System. We're not going to learn how to do that, and this is not acceptable under GAAP. So the companies cannot use this method for GAAP. They can use it only for tax purposes. Okay? This is what we're talking about. This is revising the depreciation. So let's say that the truck was supposed originally to work for 5 years. 2 years later, the company, or 3 years later, the company sees that the truck is still basically new. Why not extend the life of that truck for 4 more years, for example? In this case, what you do is, at the time the company decides to make the change, treat it as if it were a totally new asset. Restart from that time. So let's see how this is done. Arcadia HS purchased equipment for $510,000, which was estimated to have a useful life of 10 years, with a salvage value of $10,000 at the end of that time. Depreciation has been recorded for 7 years on a straight line basis. In 2015, it was supposed to be 10 years, but after 8 years, the company determined that the total estimated life should be 15 years, so they want to extend it by 5 more years. What you need to do basically is to calculate the book value of that truck at the end of the 7th year. This is the beginning of year 8, and then you start counting how many years you have. Okay? So let's see how this is done. This is going to be very quickly. When the company makes a decision, they do not correct anything in the past. You cannot correct the depreciation expense from the past because that was not a mistake. That was based on whatever you had to do before, whatever decision was before. The only thing that could change will be in the next time. And we will explain it next time as well.